If you're constantly facing losses because you can't keep your emotions in check while trading, then you should definitely apply the practical trading strategies shared in this video. Let's begin with the first technique. But before we proceed, if you find this content valuable, hit that like button. And if you're joining us for the first time, don't forget to subscribe and enable notifications so you never miss any of our latest uploads. I'll catch you right after the intro and disclaimer. Let's dive into the first trick. On this chart, the price breaks its daily low and moves downward. However, after encountering rejection at the lower levels, the price stops falling below this zone and consolidates there for a while, forming a support level. Believing that the price might take support here and push upward, you placed your stop loss just below this support area and entered a long trade at the high of this bullish candle. But shortly after, the price begins to gradually decline, causing you, and other retail traders like you, to exit the trade before the stop loss is triggered. Right after you exit, the price reverses from that exact level and starts rising again, breaking its previous high without hitting your stop loss. But at this point, you can't do anything because you've already exited your trade. Your chart analysis was actually correct, and the market is moving in your direction. So, you enter another long trade at the close of this green bullish candle, placing your stop loss near its opening. Soon after, the price starts dropping again, forming two red candles. Seeing these red candles, you exit your trade once more. The same situation repeats a third time. You enter after spotting a green candle, but when the price dips, you exit before your stop loss is hit. Now, the key question is this. Your analysis for entering the long trade was completely right, and the price even moved in your intended direction. So why did you still lose 3 times? The answer lies in your trading psychology. If you carefully recheck these 3 trades, you'll realize your chart analysis and stop loss placements were perfectly fine. You had already accepted the risk equal to your stop loss amount. Yet you exited early because of the fear of loss, a psychological reaction. Even though you had mentally accepted that small loss, you exited prematurely because the red candles triggered fear. From childhood, the color red has been associated with danger. For instance, a red traffic light means stop, and red signs on electric poles warn us of danger. This lifelong association affects our subconscious mind. So, when we see red candles on a chart, our brain automatically signals danger. That's why, even when we know we shouldn't exit, we often close our trade early, before the stop loss is actually hit. After practicing this for a few days, you'll likely notice a real improvement in your trading psychology. Let's move on to the next trick. Here, after consolidating within a range, the price breaks downward with a strong red bearish candle. Observing this bearish movement on the chart, many retail traders enter short trades after the candle closes and place their stop loss just above it. However, after moving slightly lower, the price reverses upward again and drops right after triggering your stop loss. Seeing the price decline once more, as soon as a strong red candle forms below this bearish engulfing candlestick pattern, you enter another short trade and place your stop loss above the high of the breakdown candle. But just like before, the price bounces from the lower level, hits your stop loss, and then breaks its previous swing low. Moving further down, looking at this bearish price action, you can compare it with the chart you analyzed earlier in the day. Your analysis was correct. The market did move downward, just as you expected from your short entry. However, you still ended up with losses because your stop loss was hit twice. The issue wasn't with your entry, it was with your stop loss placement. It was too tight or too narrow. Here, the market broke down from a strong consolidation zone for the first time, and the price hadn't yet made a pullback. So, it's likely that new retail traders entering short positions below this candle will get their stop losses triggered as the price pulls back into the consolidation zone to grab liquidity. That's why, whenever a strong consolidation zone or key psychological level breaks, there's always a chance the price might retest that area. Therefore, when taking such trades, your stop loss should be slightly wider so these pullbacks don't take you out prematurely. However, many traders argue that widening stop losses increases their potential losses. That's true, but to manage this situation, you can simply reduce your trade quantity. This allows you to set a slightly larger stop loss without increasing your overall risk. For example, if your trading capital is 100,000 and your maximum risk per trade is 2,000, then if you take a trade size of 100 units, your stop loss should be 2,000 divided by 100 equals 20 points. If that stop loss feels too small, you can reduce your position size to 75 units. Now your stop loss becomes 2,000 divided by 75 approximately equals 26 points. This adjustment makes it easier to keep your stop loss intact and avoid getting caught by frequent liquidity sweeps in the market. Even if your analysis is accurate, exiting trades just because your stop loss got hit can negatively impact your trading psychology. If this keeps happening, you may start doubting your skills, which weakens your mindset and makes you feel like trading isn't for you. That's why, instead of tightening your stop loss, it's far better to slightly reduce your position size. Now, let's move on to the next trick. Hey traders, you've been asking for it, and it's finally here. The 2-month SMC Trading Mastery course drops this October 18th. This isn't just another course, it's a complete system to master smart money concepts, manage risk like a pro, and build consistency in your trades. And here's the crazy part. It's only $500, plus 61% off for pre-bookings before October 18th. Oh, and we're giving away 5 $100,000 funded accounts to our students. Don't wait, click the link, secure your spot, and let's make this the turning point in your trading journey. See you inside. In this chart, the price breaks its daily low and moves downward, attempting to find support near its previous high. Seeing this setup, many retail traders get excited and enter long positions. However, after a short upward move, the price starts falling again and closes below its previous high, resulting in losses for all traders who went long here. After consolidating around this level for a while, the price suddenly forms strong green bullish momentum candles, surging upward and approaching its previous high once more. Seeing these bullish candles, some traders again enter long trades in excitement. Just like before, the price reverses downward, causing losses for all of them. In the first setup, no proper bullish candlestick pattern had formed, yet traders assumed this zone to be a support level simply because the price was near its previous high. This assumption was due to poor chart interpretation. You didn't wait for the price to close above the previous swing high and entered the trade too early. As I've explained many times in my videos, whenever the price tries to break a level directly without any pullback, the chances of reversal are significantly higher. Moreover, when strong momentum candles appear on the chart, they often act as traps for retail traders. That's why you should always avoid entering trades immediately after such candles form. Many traders make mistakes in chart reading due to excitement, which leads to consistent losses. When entering a position, confirmation on the chart is far more important than the thrill of entering a trade. Whether you're swing trading in the cash market or trading options in index markets, you won't succeed unless your trading approach becomes calm and disciplined. You must practice emotionless trading. Remember, you're here to make money, not to chase excitement like in a video game. Developing the habit of entering and exiting trades without emotional attachment is essential. Only then can you truly become a consistently profitable trader. Let's move on to the next one. When we begin our trading journey, we usually deposit only a small amount into our trading account. As time goes on, we experience both profits and losses. However, once you make a significant profit in a particular month, you suddenly decide to increase your trading volume, thinking that if you can earn well with a small capital, you can earn even more with a larger one. With this mindset, you transfer additional funds from your bank account into your trading account without giving it much thought. As your trading capital grows, you start placing trades with higher quantities in the hope of making more money. But earlier, you were used to trading with smaller amounts, and your mindset was adjusted accordingly. Now, when you suddenly start trading larger volumes, both your profits and losses have a much bigger impact on your emotions. This disrupts your trading psychology, leading to smaller profits and larger losses. Eventually, your trading account begins to deplete. Seeing this, you again transfer more money directly from your bank account to your trading account. This cycle keeps repeating, and if I'm not mistaken, to prevent this, there's a simple solution. Nowadays, most people have more than one bank account. When you open a demat account for trading, you have to link one of those bank accounts to it. So, before you transfer any money into your trading account after a loss, take a moment to ask yourself a few important questions. First, have I been following proper risk management in my trades over the past 10 days? Second, have I stuck to my trading plan and executed my entries and exits as per my strategy during these last 10 days? Third, have I been switching my strategies frequently, changing them the next day whenever I face a loss? Fourth, after experiencing a win or a loss, have I entered the next trade calmly, without excitement or emotional reaction? Fifth, did I wait for the price to reach my proper entry setup before taking a trade? All of these questions cover crucial aspects of trading discipline. If you answer no to any of them, it's a sign that you need to work on that specific area before depositing more funds into your trading account. If you ignore this and keep adding money without addressing these mistakes, you'll continue repeating the same errors, and consistent success will remain out of reach. These may sound like small details, but in trading, small habits build a strong mindset. A stable trading psychology helps you make better decisions and stay consistent under pressure. That's it for today, traders. Thanks for watching this video. Progress begins the moment you choose to take your trading seriously. If today's video gave you some valuable insights, don't forget to hit that like button, it truly supports the channel. And if you're new here, make sure to subscribe and turn on the notification bell so you never miss an update. Stay focused, keep learning, and keep raising the bar for yourself. I'll see you in the next video.